Alrighty, time for this week's Fiscal Focus, brought to you by InfoChoice, your choice of information on Australian consumer finance. Now, this week, we're hoping to delve deeper into some of the potential forces behind all of the recent cuts to interest rates on home loans and term deposits we've seen over the past week from each of the big four banks, and whether this suggests the RBA, an RBA rate cut is on the horizon. And joining us to discuss is the great economic soothsayer that is Warren Hogan, Judo Bank's Chief Economic Advisor. G'day, Warren. Welcome back to the Savings Tip Jar podcast.
Fantastic. Thanks for having me on the show again.
Thanks for joining us, Warren. At short notice, you're becoming quite the friend of our podcast, so always appreciated. Kind of what Dom was saying just briefly there, we saw a stack of home loan rate cuts last week, term deposit rates cut as well. It's easy to kind of say 1 + 1, equals, potential RBA rate cut on the horizon. But is there something more complex going on behind the scenes that that punters might not know about?
Yeah, well, it's pretty straightforward, really, and that is that all the institutions that people borrow from, banks and whatever, they just take a price in the market, the wholesale market. So the reason you're seeing all these fixed rates coming down is because the 3-year government bond yield, that is the benchmark 3-year interest rate in the market, has fallen pretty dramatically since that slightly weaker than expected CPI, then the RBA's decision not to hike, and then we got wobbles in markets. And the 3-year yield was hovering over 4%, which is about the right level when your cash rate's at 4.35. And then it collapsed. It fell all the way down to 3.4 when Japan had their bad day a few weeks ago. It's come back a bit, but it's really held at around 3.5, 3.6. So what's going on is that, let's say banks, because most people get their loans from banks, whether it's a mortgage or a business loan, the bank will just make that rate to their customers, a retail or a business customer, and then they'll automatically hedge that interest rate risk in the market. So the bank's not taking any view on interest rates there, but the market is. So it's the wholesale market, the big global market with all the big super funds and hedge funds and everyone, all the professional players. They're the ones who think an RBA rate cut's imminent. The bank itself, it's just going into that market and taking advantage of the price in the market and hedging out the interest rate risk. So does that make sense?
Yeah, it does. You explained it very well.
Yeah, cool. So that's not the bank taking a view. But what we did see, you mentioned, was CBA cut their variable rate. Now, that's a different story because that is them taking a view, and it's not so much a view on the RBA, although their economists, I believe, think there's going to be a cut in November, if not November, then early next year. So there's a bit of that confidence in the background, but really that's a market competition view. That's as in we want to get market share in mortgages from ANZ or Westpac or NAB or whoever else. So it's a good thing in the sense that people are going to get lower mortgage rates because this, I think, is just for new customers. It's not their existing customers. And look, a little bit could be this higher confidence that they think, one thing that could be is a much stronger confidence there won't be a rate hike. But again, these banks manage their risk. The variable risk is a little different to that fixed rate risk I was talking about. So yeah, look, there's no doubt that market backdrop has shifted. I don't necessarily agree with it, by the way, but the banks are just really taking advantage of what the market price is. They're not taking a strong view necessarily.
But those bond yields themselves, aren't they priced on the expectation of potential rate cuts in the near future? Obviously those bond yields impact the funding costs of these banks, which is why they're having to adjust their rates accordingly. But those bond yields, did they fall because suddenly the market was expecting rate cuts to happen in the near future?
Yeah, exactly. No, that's right, and that's the big market with thousands of players and billions of dollars of transactions going through every day. And that's exactly right. In fact, you can plot what they call a yield curve. A yield curve is essentially an interest rate of every different maturity at any point in time. So right here now, you've got the cash rate at 4.35. That's the overnight interest rate. Then you've got, say, a 3-month interest rate, 1 year, 3 year, 10 year, out to, say, 20 years. Anyway, map all those out, and that's what the yield curve's called. And you're exactly right. The 3-year interest rate, which is a real benchmark because a lot of people fix for 3 years or business loans are for 3 years, that's going to reflect basically what the market thinks the cash rate's going to average over the next 3 years. There's a bit of maths in that, and there's a bit of a premium, and there's all mathematical relationships. So if you had to take a position and buy bonds at 3.5% with the cash rate at 4.35, and you were not allowed to do anything, but you just had to hold that bond. Well, if the cash rate stayed at 4.35 for the next 3 years, you would have been much better just investing at 4.35 every day because the yield's higher. So you see what I'm saying? There's this mathematical relationships. It's all related. And exactly to your point, that was a very long-winded way of saying, yes, the market expects rates to come down. And of course, we don't necessarily look at the 3-year yield to ascertain the next year because we have 3-month and 6-month and 12-month interest rates and futures markets and various other things that are very accurate at reflecting the market view. And right now, yes, the market's pricing in a rate cut by the end of the year and a series of them next year, and that the cash rate will come down to at least 3.5, if not a bit lower in the next 12, 15 months. And of course, I can tell you from my experience as I was a bond strategist in the old days, that a 3.5% 3-year is essentially telling you the cash rate's going to average over the next 3 years something like 3.25. And so it has to be a bit lower. Now, what I'd say right here now today is I don't think that's going to be the case. I think it can get down to that level in, say, 2026, but it's not going to average it for 3 years. So I think the market's overcooked it. And of course, which we may touch on, I still don't think you can rule out another rate hike here. The market's moved massively ahead of itself in Australia. And of course, the main thrust of all of this is because things are shifting overseas, particularly in America, where the Fed has all but signaled in the last week that they're cutting in a few weeks' time. And the market's pricing in 100 basis points, 1 percentage point of rate cuts by the end of the year over there. And we're sort of mindlessly following them, which in history is not necessarily a bad thing. But our economy in 2024 and our monetary policy is in a very different situation to the US, in my view, although obviously people in the local market disagree with me on that. I think we are in a similar position.
We've got the ABS monthly CPI indicator out, I believe, tomorrow. Granted, it's less a complete look than the quarterly release. If it's weaker than expected, aka inflation's lower than expected, and with all that being said, of what you just explained just there, is that enough to sort of shift your view on what the RBA might do to close out the year? I mean, you're quite the outlier in the market saying 2 rate hikes are probably needed to truly stamp out inflation. What if it comes out softer than expected?
Yeah, well, tomorrow the real fun and games begin because the politicisation of inflation in Australia begins tomorrow with these massive government subsidies, which of course the government and some economists are saying is the government policy to reduce inflation, which is absolute and utter rubbish. It's the government policy to reduce cost of living because it's actually giving a subsidy to households to help them with electricity prices, or if you're one of the people, rent, or whatever else the Queenslanders are doing, et cetera, et cetera. But it doesn't do anything to inflation other than measured inflation. But of course, one of the great challenges of being an actual professional economist in this world is that there's another 5 million unprofessional economists out there with 1,000 different views. So it's going to be interesting to watch, but the RBA has made it very clear in a whole range of statements. They're going to look through all that and look at what the underlying pulse of inflation is. And yes, tomorrow we'll get some insight into that, but the most important thing tomorrow is working out how these subsidies are affecting the data, and that complexity and the ability for us to be confident of any assessment is magnified because of also what you said. We now also know that we've got to be careful with these monthly numbers because we all got a bit of a head fake on the last ones in April and May, thinking that was going to lead to a higher quarterly result than it did. So yeah, it's going to be. I would say it's going to be very difficult for me as someone who's been studying inflation in this country for 30 years, and that means that for everyone else, I don't think there's any chance of really having a clear idea of it. It's going to take months of these data and ultimately the quarterly number. So, but anyway, the fun and games kick off tomorrow.
I mean, it's been interesting lately in that people have been trying to sort of read through between the lines of what Michele Bullock's been saying lately, and trying to detect whether she's having a go at the government and implying that they're keeping inflation higher than necessary due to, state and federal government, subsidies and whatnot. So do you think on that there has become a bit of a schism between what the RBA is doing and what the government's doing? I mean, Michele, you can see in her speeches, she always tries to be nice and diplomatic and won't ever directly have a go at the government, because I don't think the RBA can do that, because ultimately government is her employer. But do you think they are on, the different paths at the moment?
Oh, well, yeah, definitely. I mean, Michelle's just got to be, as you said, diplomatic, and there's a whole other range of ways you describe it, but she's not trying to cause a problem for the government. She doesn't want to embarrass them, but she's also got to be factual. And something we've known for a long time is the government is absolutely pushing in the other direction. And it all goes back to the beginning of the year. If you remember, we had that rate hike in November. We got into the summer. The economy was really soft at the end of 23. Came back from summer holidays and we thought, look, this is it. The economy is now softening and this inflation will come down. I had that view. And I moved in April because I saw this economy picking up, and not GDP and not consumer spending, but employment and other measures of demand. And part of that story, which was revealed in May and June, were all these budgets from the feds in the states where they're pumping money in. So her economists had to revise up government spending numbers in their forecast. They couldn't walk away from that. They would be laughed out of the room professionally if they did that, because that would just be totally incorrect. But she's just trying to navigate that. But the reality is this government decided to chuck a lot of stimulus into the system on top of the tax cuts, on top of Queensland and their craziness. And it's really irresponsible what that government's done, because they thought the economy was on the right track and going to be soft ahead of an election. But as it's turned out, the economy's bounced. Demand's too strong. And of course, this is the absolute last thing we need. And we're going to find out this next 2 months is probably the most critical 2 months in Australia's recent economic history. Because if we get the bounce, I suspect we will, and if inflation stays where it is or worse, starts to pick up next year, we're in trouble. Now, I hope it doesn't play out that way, but the window to take out a bit more insurance and raise the rate up towards 5 is, pretty much closed, maybe not. Let's see what happens in November. But, we're not in the situation with the US. The US employment numbers in their household survey, the same survey as ours, have been falling this year. Our employment has grown by 300,000 people in 2024. So we're on a different trajectory because we never tightened monetary policy as much. And of course, we're getting fiscal stimulus now, whereas the Inflation Reduction Act and their stimulus was really 18 months ago, and it's now sort of ebbing. It's not as punchy as it is here in Australia. So she's being diplomatic. She doesn't want to cause a fuss or embarrass the government. Of course, media and politicians all want to try and get her to do something. But in the end, I'm pretty confident Michelle will do what's right. She is pushing the limits of what she can get away without raising rates. And you can just see that by looking at their forecasts. They're so worried. They're hoping it all plays out. But if she wouldn't have come out and said what she said in the last month, which is, we ain't cutting rates in the next 6 months, that was the strongest statement she made. And she wouldn't have said that for no good reason. And it was a number of reasons. One, there's this massive political desire to help the government get a rate cut before the election. So there's that whole commentariat. And then, of course, the two biggest mortgage providers in this country, Westpac and CBA, a month ago, were both calling rate cuts in November. And she's come out and said, we're not doing it. And this is a woman who has been trying to not do any guidance. So it shows you how strongly she felt about that message, which, of course, next layer down tells you if they're going to move in the next little while, it's going to be a hike, which, we're all hoping they don't have to, but I just don't think we're going to get away with it. I just think there's too much inflation in this economy.
There we go. There's a lot of talking points there. We could talk about this for a lot longer. Me personally, I'm interested in how many of those 300,000 jobs added are actually in productive sectors that aren't necessarily the NDIS. Warren Hogan, thanks so much for joining us on the Savings Tip Jar podcast. We'll let you get on with the rest of your day.
Fantastic, guys. Thanks for having me on the show once again. It's always a good opportunity to share views, so thank you.